Thank you for visiting the Theta Trader website. I am Nolan Merritt, and for the next few minutes I will give an introduction to the Theta Trader's method of analyzing index options. The first task is to review the risk disclaimer. Money in the market is money at risk. Before trading, consider your financial objectives to determine if option trading is right for you. Examples are for educational purposes only. No recommendation to buy or sell security will be given. The Theta Trader methodology may simply be described as high probability trading. High probability trading involves calculating, not guessing at, the probability of successful trade. As a Theta Trader subscriber, you will know the risk and reward of a trade and how likely a trade will work out in your favor. Before we get into the details of how we trade, I want to discuss risk for just a minute. It is important to know that risk is a necessary component of trading. Successful traders do not avoid risk, they understand risk and manage it. This is true of not only traders, but nearly every successful business venture. Let's think for a minute like a car insurance company. Insurance companies know that the premiums they collect not only cover the cost of accidents they have to pay for, but also their overhead and employee salaries. But on an individual basis, the insurance company risks $20,000 to $30,000 for $100 to $200 per month in income. They can do that because the probability of an individual crashing is small, and the policy is in place for only a specific amount of time. To help manage risk, insurance companies charge higher premiums to riskier drivers. If the risk profile is too high, then the insurance company will cancel the policy, they end the contract, and the driver is on their own. This style of risk management, of collecting premiums and monitoring market profile, translates very well to the Theta Trader methodology. Let me take you through a couple of examples. What I have drawn here is a typical options trade where a premium is collected at the beginning of the trade, and then the risk is monitored as the trade progresses. Let's assume that an index is currently at a value of 500. The analysis of the index shows that there is a 90% probability that the index price will be above the 400 price level on options expiration day, which is the third Friday of the following month, or about 6 weeks away. Sell a put contract that is centered at the 400 price level. Selling the put delivers $270 to your trading account. And if the XYZ index is above the 400 price level on options expiration day, then you keep the money and do not give anything back. The risk is if the index closes below the 400 price level, then for each point the index is below that level, you pay $100. That is too much risk. So to reduce the risk, purchase a put contract that is centered at the 395 price level. Now the maximum amount you can lose is the difference between 400 and 395 price levels. The cost of the put is $228, which leaves you $42 in gross profit, or an 8.4% return on your money. In other words, this example shows a 90% probability of making 8.4% on your money within the next 6 weeks. An important part of this trade is to manage the risk. This is done by tracking the risk factor. When the trade started, the risk factor is 10%, which correlates to a 90% probability of success. If the index drifts down, the risk factor may increase. If the risk increases to 50%, you may decide to exit the trade or modify the trade to a lower risk factor. How to manage trades to minimize risk and preserve profits is taught extensively to members. This next example is a trade that goes along with the overall trend of the market. Most people are familiar to buying a stock and making money as the price of that stock increases. This strategy is similar to that. Let's say that an index is currently at a price of 48. First, buy a call that is centered at the 45 price level and expires in about 6 months. The initial investment will be $449. If the stock price increases from 48 to 53, the value of that call contract will increase to $800. That is in itself a good trade. But in addition to the increase in the value of the call contract, you will learn how to collect premiums against that call contract. In this example, additional premiums add about $50 per month. That brings the total gross profit to $601, or 134% return on investment over the past 6 months. Compare that to buying the stock. An increase from 48 to 53 is a 10.4% return. In those two examples, I have explained the typical options trade. If you don't know what an option is, I have written here the definition. As part of the education, you will learn all you need to know about the option contracts. When selling an option, you collect a premium similar to selling an insurance contract. Basically, you are selling time, which gives you an opportunity to make money simply because time is passing. Now I'll take you through a brief tour of the website. First, the website provides analysis and tracking tools for 2 indexes and 3 exchange-traded funds, or ETFs. Exchange-traded funds are very similar to indexes. They are made up as a composite of many stocks in the same sector. The 5 symbols traded are SPX, which is the S&P 500, the SPY, the S&P ETF, RUT is the Russell 2000 index, IWM is the Russell ETF, and finally the Qs, the NASDAQ Exchange Traded Fund. The advantage of only having 5 symbols to track is there is no searching for that golden stock to trade, no complicated chart analysis or fundamentals of a company to review. The bottom line is that once you understand the strategies, and there are only 3, the time needed to analyze a new or existing trade is less than 10 minutes on average. Let's take a look at the website. The first page you come to after logging in is the overview page. Here you see the 5 symbols, the Russell 2000, the S&P 500, and the NASDAQ at the bottom of the screen. The columns on the left are for call contracts, the right column is for put contracts. An important part of trading these strategies is to collect the highest premiums possible and enter trades at a time that is most likely to succeed. To accomplish that, there is built into the trade pages a simple visual color scheme. Red means be cautious. It is probably not the best time to trade these contracts. When you see yellow, it means the timing is more favorable and to be ready to enter a trade. Green means go. If you like the trade and agree with the analysis, then enter the trade. The month to trade dropdown shows you which months are available to trade. The risk factor allows you to choose a risk that matches your personal risk tolerance. For example, if you want an 85% probability of success or a 15% risk factor, you scroll down to the 15% and the website will show you which options to trade. These tabs are the trade details. Let's say the SPX trade looks interesting to you. Click on the SPX tab and the details of this trade will appear. This chart on the left shows a 2-year history. This chart on the right is the past 6 weeks. These 2 rows of color boxes show a history of the market timing, and the last box on the right corresponds with today. The row on the top represents the calls, the row on the bottom represents the puts. Below the charts you see the same trade from the overview page. Again, you may change the month to trade or change the risk factor. Currently what this page is showing is that the puts have a favorable time to trade and a risk factor setting of 15% or an 85% probability of success shows a 14% return on investment by July 16th, which is about 6 weeks away. If you see a trade you like, take this information and execute the trade with your broker. Once that is done, click on the Trade button. This Add Trade page gives you the opportunity to verify the trade you executed with your broker. For example, maybe I'd like to do 5 pairs of put contracts. You may also choose to paper trade by clicking on the Paper Radio button. Paper trading is an excellent way to learn these strategies without risking any money. Once you've made your choice, click the Add Trade button and move the trade into the tracking screen. You will want to view the tracking page on a regular basis because this page shows you how trades are progressing. Here is the paper trade that we just executed. The columns on the right are what you want to pay attention to. Here is the risk factor of this trade. As the market moves, the risk factor will change. If a risk tolerance is reached, then you may exit or modify the trade to a lower risk level. How to modify a trade to reduce risk and preserve profits, again, is taught extensively to members. Delta shows how much money may be made or lost as a market moves up or down. Theta is the Greek symbol used to represent time. We use it to show the daily profit potential. In other words, this trade has the potential to make $9.39 per day simply because time is passing. There are many more important features of the website. Some I listed here, such as the website has the ability to send trading alerts to email or cell phones. There are recorded trainings on how to correctly size your positions, how to turn losing trades into winners, how to be neutral in market direction, and several other important topics. Theta Traders not only provides analysis and tracking tools, but also a comprehensive hands-on training program. I believe the best way to learn to trade is live in the market with a mentor. Training takes place for 6 to 8 weeks. The first 2 weeks are an introduction class with paper trading to learn the language and become familiar with the strategies. The next 4 to 6 weeks we trade live in the market on an account funded by Theta Traders. The class members make the trading decisions with guidance from the instructor. Trainings are held via webinar and recorded for individual review. In addition, there is ongoing training each week for market conditions and an opportunity to ask questions. This concludes the brief introduction to Theta Traders. If you have an interest in becoming a member, please contact me at the following email address.